A powerful wave of uncertainty is moving through today's real estate landscape, leaving buyers, renters, and even longtime homeowners unsure about the future. Prices look stable on the surface, but several underlying forces are quietly reshaping the market from the inside. Some cities feel overheated, others feel frozen, and many people cannot understand why supply feels so tight even when demand appears weaker. This video breaks down what is really happening to the housing market right now, uncovering the hidden pressures, the shifting patterns, and the structural changes influencing both short-term movement and long-term trends. Before going further, don't forget to like, comment, and subscribe to the channel for more. Number 10. A sudden freeze in housing inventory is creating artificial stability. In many parts of the country, housing inventory has dropped to levels not seen in decades. This dramatic shortage isn't the result of rising demand, but rather a mass unwillingness among homeowners to sell their properties. Many households are holding mortgage rates far lower than anything available in the current market. Losing those rates would mean significantly higher monthly payments, even if the next home costs roughly the same. This has created a strange environment where homeowners want to move but feel financially trapped. Families who need more space hesitate. Retirees delay downsizing, and potential relocators simply stay put. Because of this frozen behavior, new listings remain scarce, leaving buyers with very few choices. This artificially low supply stabilizes prices even when demand cools. Instead of a natural price correction, the market becomes tight and sluggish. Fewer homes enter the market, bidding wars stay alive in some regions, and buyers often feel pressured despite not seeing real competition. This imbalance supports price levels that would normally drop under weaker demand, creating a confusing environment where prices stay high, even as fewer people are buying. Number 9. Mortgage rates are reshaping buyer behavior and affordability. Mortgage rates now play a larger role than almost any other factor in deciding who can buy and who must wait. Elevated rates shrink purchasing power, making previously affordable homes feel far out of reach. A typical household may qualify for far less than they did just a few years ago, forcing them to reconsider neighborhoods, square footage, and overall expectations. This shift in affordability has a deep psychological effect. Many potential buyers delay entering the market because payments feel too heavy to justify. Others feel unsure about long-term economic stability and prefer to hold off rather than risk overextending. Even buyers who remain interested approach the market with more caution, more negotiation, and more hesitation. Sellers feel this shift as well. Homes that once sold quickly now sit longer. Some markets experience quiet price adjustments, while others rely on incentives rather than open price cuts. Mortgage rates essentially control the speed of the market, slowing transactions, cooling activity, and putting pressure on both sides of the deal. Number 8. Home prices are not crashing, but they are quietly correcting in key regions. Many predictions of a massive price crash have not come true, but that does not mean the market is untouched. Instead of an explosion, the market is experiencing a silent, targeted correction. Areas that saw extreme pandemic-era price jumps are now seeing softening demand and moderate price pullbacks. Regions with heavy investor presence, rapid suburban expansion, or high speculative buying are stabilizing at more realistic levels. However, this cooling is uneven. High-demand metropolitan areas with strong job growth continue to hold value, while others with population declines face more noticeable drops. This creates a patchwork pattern across the country where some zip codes remain highly competitive and others experience slower movement. Behind the scenes, these corrections reveal the true state of the market, not collapsing but recalibrating. Inventory, interest rates, remote work shifts, and demographic changes all influence how each region responds. Instead of a dramatic nationwide downturn, the housing market is going through a complex, location-specific rebalancing process. Number 7. Rent prices are stabilizing, but not for the reasons many people expect. Rental markets in several cities appear to be stabilizing or even cooling, but the cause isn't always increased supply. Instead, economic pressure, affordability concerns, and lifestyle adjustments are driving many renters to make more strategic decisions. More households are choosing roommate arrangements to save money. Others are moving in with family or extending lease terms to avoid rising costs. These choices reduce movement within the rental market, which slows down demand. At the same time, certain cities that experienced massive population inflows are now balancing out as migration patterns shift again. Some renters are leaving high-priced urban centers for more affordable regions, which reduces pressure on local rental prices. However, stabilization doesn't mean rents are cheap. It simply means the rapid upward surge has paused. In many areas, rents remain at historically high levels, and relief may depend on broader economic conditions and future housing construction. Number 6. Investor activity is changing as profit margins shrink. Investors once raced into the market with rapid purchases, but conditions have changed dramatically. High interest rates reduce profit margins for rental property owners, making many deals less attractive. Short-term rental markets are oversaturated in some regions, reducing income potential and increase in vacancies. Many investors now face higher operating costs, tighter regulations, and slower appreciation. This has pushed some smaller investors to step back, pause new purchases, or even exit certain markets. Larger institutional investors are becoming more selective, focusing on properties with long-term rental demand rather than speculative quick flips. This shift impacts the overall housing landscape because investor activity influences inventory, competition, rental availability, and neighborhood development. The slowdown in investor purchasing helps cool overheating markets, but it also reduces the number of available rental units in certain regions. As investors become more cautious, the market enters a more balanced but slower phase. Number 5. New construction is rising, but not enough to solve the real problem. New home construction has increased in several regions, offering a glimpse of relief for buyers who feel trapped by low supply. Builders are completing more single-family homes, townhouses, and multi-unit developments than in previous years. However, this rise does not fully solve the housing shortage because the gap between supply and demand has grown for more than a decade. Construction slowed dramatically during past economic cycles. Labor shortages delayed timelines, and material costs surged far beyond original projections. These issues created a long-term supply deficit that cannot be fixed quickly. Even with more building activity today, the number of new homes remains far below the level needed to balance the market. Another challenge is affordability. Builders often focus on higher-priced homes because profit margins are better, leaving middle-income families struggling to find reasonably priced new properties. Entry-level homes remain scarce in many regions. This mismatch between what buyers need and what builders produce continues to push younger households into renting or delaying home ownership. As a result, while new construction offers progress, it does not fully address the deeper structural shortage that has built up over many years. Number 4. Demographic shifts are reshaping housing demand. Major population changes are redefining where people live and what types of homes they search for. Younger generations are forming households later due to economic pressure, student debt, and high living costs. This slows the transition from renting to home ownership, affecting demand patterns in suburban and urban areas. At the same time, older generations are living longer and staying in their homes for extended periods. Instead of downsizing in their 60s, many choose to age in place because healthcare advances and remote lifestyles allow it. This reduces the number of larger homes entering the market and increases competition among families searching for space. Immigration, migration to more affordable states, and shifts in job centers also influence local demand. Some cities experience intense housing pressure, while others see softening demand as populations move elsewhere. These demographic forces create an uneven map of supply and demand across the country. This wide variation makes the housing market complex to read. National averages often hide local realities, where some neighborhoods feel overheated and others feel slow or stagnant. Number 3. Economic uncertainty is slowing buyer movement. Concerns about inflation, rising living expenses, employment trends, and long-term financial stability are causing many potential buyers to wait before making a major purchase. When households feel unsure about the broader economy, they naturally hesitate to commit to large financial obligations such as mortgages. Economic uncertainty affects not only buyers, but also sellers. Some homeowners fear that listing during a slow period could lead to lower offers or extended time on the market. This adds another layer to the inventory freeze, keeping homes off the market and limiting buyer choices even further. Worries about job stability also influence decisions. Remote and hybrid workers may avoid relocation until companies finalize long-term work policies. Certain industries are experiencing restructuring, causing families to stabilize their finances before considering a purchase. This caution creates a cycle: fewer buyers, fewer sellers, less movement, and a slower market overall. Stability in the housing market often depends on confidence, and right now, many households simply want more clarity before making their next move. Number 2. Affordability has reached its breaking point. For many households, the biggest challenge is not supply, not demand, and not investor activity. It is pure affordability. Home prices remain elevated, mortgage rates are high, and everyday expenses continue to rise. As a result, even dual-income families struggle to enter the buyer pool. Affordability issues affect every stage of the housing journey. Renters find it difficult to save for a down payment. Homeowners hesitate to upgrade, and middle-income families face higher monthly payments than they can comfortably manage. This bottleneck slows the entire housing system. The affordability crunch is also reshaping preferences. Many families search for smaller homes, longer commutes, or emerging markets with more achievable price ranges. Others choose to postpone home ownership altogether, directing their budgets toward financial stability instead. Affordability challenges form one of the biggest reasons the market feels stuck. Without significant changes in income levels, interest rates, or housing supply, this pressure is unlikely to disappear quickly. Number 1. The market is transforming into a long-term, slow-moving cycle. The single biggest truth about today's housing market is that it is entering a long-term transition phase. Instead of rapid growth or sudden collapse, the market is moving through a slow, structural shift shaped by affordability, demographics, inventory shortages, and economic pressure. This new cycle means fewer dramatic swings and more gradual adjustments. Prices may move slowly, supply may improve gradually, and buyer activity may return in phases rather than surges. The era of explosive increases and fast turnover is fading. A more balanced but slower market is taking its place. This shift requires buyers, renters, and homeowners to think differently about their decisions. Timing becomes less about quick wins and more about long-term planning. Market changes become less about sudden waves and more about steady trends. Understanding this transformation helps people make informed decisions rather than reacting to headlines or short-term fluctuations. The future of housing will depend on how well supply expands, how quickly affordability improves, and how confidently households respond to economic conditions. The housing market is moving through one of its most complicated phases, and understanding these shifts helps every household make smarter decisions about the future. As prices, rates, supply levels, and economic conditions continue to evolve, staying informed is the strongest advantage anyone can have. Thank you for watching, and don't forget to like, comment, and subscribe to the channel for more.